Hi, you're watching Investor Insights. It's 7 in the morning, Thursday, the 22nd of August. It's been a wild night's trade. The market just closed about an hour ago. The FOMC minutes came out roughly about 3 hours ago. Markets were down initially, about 50 points on the Dow. When the minutes came out, they fell another 50, and then they rallied to be in the money. That lasted about 5 minutes, and basically by the end of the day we're down about 100 odd points on the Dow. And I don't know why the market swung the way it did, because there's nothing new within the statement. The rhetoric is exactly the same as it was probably the past 3 or 4 months, and even the language is neither really hawkish nor dovish. People perceive the fact that the Fed has already mentioned the word tapering of purchases, so they just assume that that's what's going to happen. But as I've stated in so many videos previous to this one, that the Fed is not going to taper, and even if it does, it's going to be very minute. The consensus is a reduction of 10 billion a month. What difference does it make? They're spending 85 billion. They're reducing by, what's that, about 12%. It's not going to be a huge difference. What it does show is that the market has always been on shaky grounds, and when you have a whole big bunch of lemmings just having a risk-free foray into the stock market or the bond market, of course everyone's going to bloody jump in. But now a lot of risk has been put back onto the table, and although technically the Fed's not going to do anything, people have just grown a little bit more wary of what could possibly happen. Now, I'm looking at an article here from what's that? It's about 24 hours ago, from America, CNBC.com, and this guy, Larry McDonald, reckons that now's a really good time to buy bonds. The 3 reasons he says is 3 reasons why everybody's wrong about the bond market. You guys can look it up. I'll put a link in the description box. Let's just say it's a waste of time. Whatever this guy reckons going to happen, it's not going to happen. Right? The Fed isn't going to taper. And if it doesn't taper, then yes, you can speculate it in bonds. I would never call it investing, simply because when you invest your money, you're looking for a return. And buying bonds, regardless of if it's at a 10-year at trading at 2.8, 2.9, even if it falls back to 2.3 or even 1.5, it doesn't matter. If inflation's running at 5 or maybe 10%, anything below, obviously 5 or 10%, is like taking your money and flushing it down the toilet. So to me, it's not an investment. So any speculator or commentator, whatever they want to call themselves, go out there and put articles telling people to buy bonds. It's crazy. There seriously has to be a mentality check with all these people, because when things are overpriced and you're living within this speculative environment, it's very hard to see outside the bubble. So when you don't really perceive the risks to be there, of course you're going to jump in. Everybody else is making money, so why shouldn't you? Well, in this case, you might make the odd buck here or there, but in the long term, you're going to lose a lot of money in bonds. you're going to lose a lot of money in the stock market and even in the real estate market. I can't really see how there's an answer to this debt issue except for getting rid of the debt. And because America and Europe's broke, there's no way of paying off debt, and that debt just accumulates even more unproductive debt in the form of interest. There's no growth to repay any of these bonds. So if you were an investor, seriously, just look the other way. On another note, I had a discussion with my father just yesterday, and I wouldn't call him a financial person, a technician, or anybody who knows really anything about what's going on in the world right now, except that even he notices that stock markets are going up. And one common thing that I look out for is when my old man starts talking about the stock market's looking good, you know that it's time to get out. I'm not trying to insult him, of course, but this is just a quick way to sort of assess the situation with stock markets. But I was talking to him about the American debt situation, and I didn't have to talk about yield. I didn't have to talk about anything too technical. All I asked him was, if you were China as a country and America owed you a whole bunch of monies, and you keep on shipping goods to them, and in exchange for those goods and whatever else that you're shipping, all you're getting paid back in is just little pieces of paper, IOUs. And the more the interest accrues on them, the more pieces of paper that they give you. And as you're noticing that inflation is now starting to run, with WTI running at about 105 odd, you're noticing that those little pieces of paper are worth less and less money. And you stupidly decide to peg your currency with the US dollar, so any inflation that's there is just going to come flying over to you. So in the long run, America owes you probably about $2 trillion. Don't quote me, it's just a number. $2 trillion, and the interest, you've never seen it paid back or anything. All you see are more pieces of paper. And every year you just keep on shipping maybe $400 billion worth to them, and again more pieces of paper come flying your way. How long will it take before you snap and you ask for your money, or gold, or platinum, silver, whatever? And he just looked at me and he said, well, obviously not very long at all. He wouldn't even let it get to 2 trillion. He would have said something a long time ago. This is also because my old man's rather tight. So anyway, that's a different story. But this goes to show you that Main Street has common sense. Wall Street has no sense. And the public sector, especially the central banks, clearly have no idea. Or the central banks may have an idea, but their idea of getting rid of the debt by inflating everything and making the debt disappear, as blatant as it seems and as obvious as it should be, most people don't see it. And when you always hear about tapering fears and the stock markets being rolled over by I think the word I saw in this article this morning was here it is, tapenado, or tornado, taper, nado, whatever. The stock market should be priced according to companies' earnings. Now, companies' top lines aren't increasing, so therefore there's no growth. All growth comes from bottom line, which is reduction in costs, streamlining the company, maybe reduction of debt. But in general, to see genuine growth within any environment, companies have to show top-line growth. Top-line growth being your revenues. And if your revenues, and in probably half the companies, the revenues are shrinking. And if you think about it, when your revenues are shrinking in a very inflationary environment, it means that your real income growth or your real revenue growth is actually shrinking by the day. It's a scary thought that people are still piling into the stock market, chasing really fanciful returns. And I would rate this as just a real house of cards, and you just don't want to be left holding the bag, being the biggest fool. I'm reading several articles that are saying that the markets now are looking cheap, with the S&P at 1630 odd, the Dow just below 15,000, about 14,850 odd on the futures. The stock market has rallied this year about 10% to date roughly, and it's easily 30% above where its nominal moving average has been for the past 5 years. In terms of earnings, it's all inflated. It's all inflation masquerading as growth everywhere. So if you were to put money in the stock market, you're just playing with fire. And it's not me trying to be a doomsday sayer or doomsday prophet or anything of the like. I mean, I don't want the world to end or the financial system to collapse. But seriously, if anybody can see a way out of this debt issue, and I still call it a debt crisis, whether it be in Europe or America, and just because you don't hear about it doesn't mean it's not there anymore. And the fact that they're creating a lot of inflation but they're not admitting to it means that all your hard-earned savings, all your parents' hard-earned savings and their parents and whoever else hard-earned savings that they've accumulated over the years is going to come to nothing, because the inflation is going to rip all those money assets apart. And it's a really, really sad state of affairs. But for now, I'm not going to dwell too much on it. I'm just going to go to bed now. It's been a long day. And we'll see how the market's going to trade today when it opens in about 3 hours in Australia. And I'll see if I can make an update when the European markets open in roughly about 10 hours time. So until then, have a good one.